James and Liz hit $500,000 in retirement savings in March. 4 months later, James is still working overtime he does not want, and neither of them can say why the milestone did not change that. Nobody told them the balance only answers half the question. Here is the other half, and why it decides whether your own milestone changed anything at all. They have been saving toward that figure since their 30s, and for most of those years, it was shorthand for being okay. The account crossed the line in March. Nobody called. The property tax bill was on the counter that same week, and Liz has since run the same conversation in her head a dozen times. It ends the same way every time, which is that they should probably both keep going exactly as they are for one more year. That is not because $500,000 is a disappointing amount of money. It is that the balance was never the number that answers the question. Treating that balance as the scoreboard is a perfectly reasonable instinct. It is the number they have checked for 25 years, the one that moved up whenever they did the right thing. Before going further, be clear about what that number is. When I say $500,000, I mean retirement and investment money that can eventually buy groceries. Not a net worth that counts the house, the cars, and the equipment in the garage that James values at roughly double what anyone would pay for it. Home equity can matter enormously, but it does not cover the electric bill in March. So the balance is real money. The trouble is that it answers a question James and Liz have stopped asking. All that time, the question was, how do we make this bigger? The question now is, what is this supposed to do? And a balance has no opinion about that whatsoever. The part everyone starts with is what the money pays, and that part is actual math. The most recent Morningstar retirement income research puts a safe starting withdrawal rate at 3.9% for a new retiree planning around a 30-year retirement. On $500,000, that is $19,500 a year, or about $1,600 a month before taxes. If most of it sits in a traditional 401k or IRA, some belongs to the IRS on the way out. Call it roughly $1,500 that reaches the checking account. That calculation takes 90 seconds, and James and Liz already had a rough sense of the answer. It is not what has them stuck. Look at what it settles and what it does not. $500,000 is more than the median American household earns in 5 years. It sounds like an answer. $1,500 a month sounds like a part-time job. Both of those describe the same money. For a household with no mortgage and modest costs, $1,500 a month is close to the whole ball game. For a household still carrying payments, it disappears before the month does. Same money, opposite meaning. So the balance can tell you what it pays. It cannot tell you whether that is a lot, because it has no idea what it is being asked to cover. That second half has never once appeared on their statement, and it is the half that decides everything. So find the second number, and notice that this is a different calculation from the one before it. The first told them what the portfolio pays. This one tells them what it has to pay for. James and Liz spend about $5,500 a month on things they consider essential: housing, insurance, utilities, food, transportation, medical costs, the debt payments they already owe, $66,000 a year. Against that, they have Social Security coming. The average retired worker benefit in January of this year was $2,071 a month. Two career earners land near $49,000 a year combined, and their own statements are more reliable than any average. Now subtract $66,000 of essential spending minus roughly $49,000 of dependable income. That leaves about $16,000 a year, and that is the only number that matters because it is the part nobody else is paying. $16,000 a year out of $500,000 is about 3.3%. The portfolio can safely produce closer to 4%. So the job is inside what the money can do, with a margin. That margin matters because the same Morningstar research also models a harsher case. Price in a long-term care shock for someone claiming Social Security at 67, and the safe starting rate drops to 3.5%. James and Liz need less than that. Even with the shock built in, the job fits. $500,000 by itself was an impressive figure attached to no particular meaning. $16,000 a year is a job description. It tells James and Liz what the money is for, which is the first useful thing either of them has learned in about a decade. But that $16,000 is not a fixed number, and the reason is sitting inside the $5,500 a month. About $1,900 of their essential spending is not really groceries or insurance, it is debt. A mortgage at $1,450 a month with 9 years left on it, and a car payment of $480. Those payments have an end date, which property taxes never will. So that total is not one fixed number. It is one number now and a smaller one later, and the retirement they are planning for happens during the later part. $1 of mortgage and $1 of groceries look identical leaving the checking account. Only one of them stops. Take the mortgage out, and their essential spending falls from $5,500 a month to a little over $4,000. That is about $49,000 a year, which is roughly what their combined Social Security should cover on its own. The portfolio's job goes from $16,000 a year to almost nothing. Put those two versions side by side. The same $500,000 is a portfolio carrying $16,000 a year with the mortgage running, and a portfolio carrying almost nothing without it. Same balance, same statement, two different retirements, and the only thing that moved was one line of spending. Now put a savings number on that payment. $1,450 a month is $17,400 a year. Producing that much from a portfolio at a 3.9% withdrawal rate takes about $445,000. So clearing that one payment before the paychecks stop does almost as much for their retirement as doubling the account they spent 25 years building. That comparison is not a trick. It is what happens when you look at both sides of the equation, instead of only the side with a login screen. For 25 years, the only lever James and Liz could see was the balance. Save more, contribute more, watch it climb. The other lever was always there. It just never showed up on a statement, so it never got measured, and what does not get measured does not get chosen. Watching only the balance has a price right now, before either of them retires. James is putting in extra hours to add money to an account that already covers its job. Every hour goes toward the lever that is nearly maxed out, while the lever that would erase the portfolio's whole assignment sits untouched. And the cost is not only financial. Liz has been postponing a conversation about dropping to 3 days a week for 2 years because she believed the household could not afford it. The gap math says something different. If dependable income covers their essential spending later and the portfolio only has to bridge, the question changes. Whether Liz works 5 days or 3 becomes a question about their life, not their survival. None of this means James is wrong to work or that overtime is a character flaw. He is doing the thing that worked for 25 years. It stopped being the best use of his hours the moment they could see the gap. Nothing on his statement was ever going to tell him that, because a statement only reports one side. They have been answering a life question with an accumulation reflex. Watch how this unfolds over a year, because it is not one clean decision. In March, the account crosses $500,000. James and Liz look at it, feel a small flatness neither of them says out loud, and go back to work. 4 months later, they finally sit down with the real numbers instead of the balance. Essential spending, dependable income, the gap, and the fact that $1,450 of that spending has a finish line on it. They make 3 changes. James stops volunteering for overtime. Liz moves to 3 days a week starting in September. That lowers her income, keeps her benefits, and gives back 2 days a week while she is 60 and healthy enough to use them. And the money they were adding to the retirement account goes toward the mortgage instead. That does not grow the balance at all, but it shortens the only obligation that was ever in the way. Then, in October, the market falls, and the account reads $462,000. That is the real test. 3 years ago, $462,000 would have looked like an achievement. Now it feels like losing something. But nothing that actually mattered moved. Their essential spending did not change. Their Social Security did not change. The mortgage got shorter. The portfolio's job was about $16,000 a year in March, and it is still about $16,000 a year in October. At the lower balance, that job takes a slightly bigger slice, and the portfolio still covers it without strain. The number fell below the milestone. The plan did not move at all, and that is only obvious because they finally wrote down a second number to check the first one against. They do not sell anything, and Liz keeps her reduced schedule. The mortgage payments continue, which is the only thing in the picture that improves while the market falls. By spring, the account is back near $500,000. It means considerably more the second time, because now it has an assignment. There is a version of this that goes badly. The math on the mortgage is real, but you cannot get there by pulling $130,000 out of a traditional retirement account in one afternoon. That withdrawal is taxable income in a single year. It can push them into a higher bracket, and it permanently removes those dollars from compounding. The math that made the payoff attractive assumed redirected savings or cash outside the retirement accounts, not liquidating the thing you are trying to protect. Reducing work has real costs too. Liz earns less for several years, she contributes less, and if her employer ties anything to full-time status, that changes. None of it makes the decision wrong, and all of it belongs in the calculation. One boundary matters more than either of those. The gap math assumes both Social Security checks keep arriving. When one spouse dies, the household keeps the larger benefit and loses the smaller one. $49,000 becomes roughly $25,000. Essential spending does not fall by half. That plan works while both of them are alive and needs a separate answer for the years when one of them is not. And for some households, the gap is too large for $500,000 to close. Even with the debt gone, the milestone still bought something, just something smaller. The ability to leave a job that is damaging you and take a calmer one. Sometimes the first freedom is not retirement. It is no longer being cornered. So here's how to find your own second number. 4 steps, and an evening is enough. First, write down your essential monthly spending, not your budget and not your average. What actually has to be paid if nobody in the house is working. Housing, insurance, taxes, utilities, food, medications, minimum debt payments. If you are under 65, include what health coverage would cost you without an employer. At this age, nothing else moves the number more. Second, write down your dependable retirement income. Social Security from your own statements rather than an average, plus any pension or annuity, not your portfolio. Third, subtract the second from the first. That is the gap, and it is your portfolio's actual job. Divide it by your balance. If the answer lands under about 4%, the money can likely do the work. If it lands well above that, something else has to change, and now you know exactly how much. If the gap comes out larger than the portfolio can carry, that is information, not a verdict. It tells you the size of the change you need, and it points at spending and timing rather than the balance. Fourth, look at how much of that essential spending has an end date. Every fixed payment with a payoff date is a future version of your gap that is smaller than today's. Removing $500 a month permanently does what another $150,000 in the account would do. Let's go back to James, picking up overtime he does not want. The overtime was never really about money. It was about not knowing. When a balance is all you can see, saving more is all you can do. One more year always feels safe because it pushes that number up. The balance is a report card. It measures 25 years of decisions that are already finished, plus market conditions nobody chose. By that measure, James and Liz did well, and nothing about that report card is going to change now. The gap is a forecast. It is the only figure here that describes the next 20 years instead of the last 20. And unlike the balance, most of what sets it is still inside their control. So that is the part that goes unsaid about reaching $500,000. It does not answer the question you think it answers. It is not telling you whether you can retire. It is telling you how much room you have to maneuver between now and the day you do. And how much room you have depends far less on the number you just hit than on how much of it is already spoken for. If you want retirement numbers turned into decisions you can actually make, subscribe to Benji Knows Money. That is the whole job here. And one more thing. And it catches the people who get all of this right. 25 years of saving builds a reflex that does not switch off just because the math says it can. Knowing the money works is not the same as letting yourself use it, and that is what we'll tackle in the next video.